Okay, hello everyone. So we are now working on session 23. If you've been carrying on, maybe after break time, or whether this is a standalone session, it would be a good idea to just revisit your notes from session 22, because we are working on um, ratios. This one is learning aim F4 and it's measuring liquidity. So, firstly, though, I don't know whether this is going to work. It's completely new, as I'm not with you at the moment. I've done a little Menti. So, if you can look at the link and click the link, or even type in the link, and let's see if it works. What I'd like you to do is add two words, two key terms which are known as a financial statement. Okay, so a statement of financial position, which is learning aim F2, and we'll see whether this works. I'll be able to check it from my place, and hopefully, what will happen is everyone will put some type of key term or word in, and I'll be able to see what the ones are. Obviously, I can't show you the graph or my side, which I would normally have up on the screen, because I'm not with you. Right, but it'll be good to kind of see from my point of view, as the last video for you may have been remote if you for learning aim F2. So enough waffling on about the recap. As always, effort plus difficulty equals learning. You need to be putting in the effort. If you're not going to put in the effort, you're not going to learn anything. And it needs to be too difficult. It needs to be something that is new. That then will establish learning. As always, my retention pyramid, the more you practice, the more you do, the more you discuss, the more you teach others, the more of that information you will retain. This is needed for your exam units. If you sit there and just get lectured to, you will only retain 5% of that information. This was developed in the 60s and it's not changed to date. Okay, so we're moving on, and that is learning aim F4. I expect this video will probably be about 45 minutes, but realistically taking you an hour to an hour and a half minimum to complete. So learning aim F4 is measuring liquidity. So firstly, we'll need to look at what the term liquidity means and how liquidity is calculated, the formula used for liquidity, and what liquidity is used for. So go back to your knowledge organizer, which you was provided last lesson, learning aim F3. It's a colour piece of paper with 3 separate boxes of your measuring profitability, measuring liquidity, and measuring efficiency. These are the formulas that you are going to need to learn. These will not be provided to you in the exam. So we need to be able to measure these two ratios, which is the current ratio and the liquid capital ratio. And always we need to calculate, which is going to be worth 3 marks, interpret, analyse, which will be worth 6 to 8, and evaluate, which will be worth 10 to 12 of an exam question. Teacher, feel free to pause the video at any point, and I will be putting in natural breaks in there as well. As I said before, there is a ratio sheet, making sure that you have access to that ratio sheet. This will help you as a lot as you go. Make as many notes of you as you wish. So slide 7. So define the term liquidity. So teacher, to pause the video, give the learners 2 minutes. Can we come up with a term liquidity? We did talk about this in learning aim F1 and F2. And can we define liquidity? I'll move on in 10 seconds. Okay, liquidity means how quickly you can get your hands on cash. All right, so effectively, it's how much money you can get access to, cash, at that point. So we talked about liquidity and maybe having working capital in a couple of weeks ago. Current assets minus current liabilities. What you are bringing in, sales revenue, the income minus the actual debt that you have, your liability. So in order to measure liquidity, you need to know the two ratios. And those two ratios are current ratio is the current assets divided by the current liabilities. And liquid capital ratio is the current assets minus your inventory divided by current liabilities. You need to know and remember those two ratios. So that will be question 1 on your worksheet. So what is a current ratio? So what it does, it compares the assets to current liabilities. Now we have done that during Learning Aim F2, which is working capital, but in a financial point of view, in terms of an actual currency value. So £2 in current assets to £1 in current liabilities. It would equal your working capital of £1. But this is a ratio. So it's the liquid ratio that measures your company's ability to meet its short-term obligations. Or, because the word current, it means it's due within 1 year. So it tells an investor or an analyst, which is you at the moment, can you pay off your debt? Can you pay your debt within 1 year? So an ideal ratio means 2 to 1. So for every £2 as a current asset, you only have £1 in liability. So for every £2 in the bank, you have £1 of a liability, which means you can meet your day-to-day expenses, you can meet your 0 to 1 year expenses, and you can also maybe seize on some opportunities if they come forwards. I'll leave this on the screen. You will notice a term in there, working capital. Pause the video, have a look, have a read. I won't go through these. So question 3. Calculate current ratio. So it's the current assets divided by the current liabilities. So for example, on this question, you do your 4 million, 4 and 6 zeros, divided by 2.6 million, 2, 6 and 5 zeros. Teacher to write the answers on the board as well and the questions, because this will be helpful at a later date. And you should have then been given the answer of 1.5. Now this shows the current ratio of being 1.5 to 1. So for every current asset, we have £1.50 to every £1 of a liability. Therefore, it is slightly below the ideal. And that is measuring liquidity using the current ratio method. Now we're going to move on to liquid capital. So liquid capital compares current assets less the inventory. So if you think inventory, i.e. stock, is a current asset because you will sell that within 1 year. So what current asset means is the actual cash in your business at that point. So current assets less inventory, so it's only the monetary value now, where previously we looked at the current assets, which included your inventory and included your stock. We're now only looking at what actual cash you have in the bank minus the liabilities you have within 1 year. An ideal ratio is 75 pence as a liquid asset, 75 pence in the bank to every £1 in liability. Now just remember, that is current liability. So that is payable within 1 year. It doesn't mean it's payable immediately. It might be the tax bill at the end of the year. So an ideal ratio is 0.75 to 1. For example, 75 pence in cash in the bank out on that actual day, minus anything that the business owes within 1 year, and that is liquid capital assets. So we're now going to look at a formula. I'll leave that on the screen just to have a read of it, and I'll move on in 10 seconds. So for this question, which is question 4 and question 5, we're going to have a go. So we have our current assets, which are 4 million, minus our inventory, 1.5 million, and the teacher to write this on the board, which gives us the answer of 2.5 million. There, we divide that 2.5 million by 2.6 million, which gives us an answer of 0.96. So that is the liquid capital ratio. It is 0.96 to 1. Now, as we previously identified, an ideal range is 0.75 to 1. So for every 75 pence of money, cash in the bank at that point, to £1 in liability. So our liquid capital ratio is very healthy because we have 96 pence in the bank to £1 of liability. So question 6. Use this information to make assessments on how the company is performing. Okay, apologies if you keep hearing stopping and starting. My cat keeps coming in and wanting to have some fuss. So I'm having to pause the video and obviously give Bunny some fuss in between each take of the video. So we'll move on. So question 6, use this information to make assessments on how the company is performing. So what does this information tell us? So it tells us that the company has a healthy liquid ratio, as both the current ratio and the liquid capital ratio are at or above the industry standard. So the information suggests that the company can pay its current liabilities using the cash in the bank, or by paying or by selling the inventory, i.e. selling the stock within 1 year to pay for its current liabilities. Now, there are a few factors which may affect a healthy liquidity ratio. For example, trade receivables not being paid. So when you're selling a product and if you're selling it on credit, the customer's not paying, because on your cash flow, you are suggesting that 30 days term, that business will be paying you in the next 30 days. Obviously, there's competition. So competition may open up, may try and undercut your prices, or the industry/market that you're operating in. Just think about like the travel industry over the last 2 years. 3 years ago, they would have thought that their current assets would have been much higher than they actually were because of the coronavirus and people not going on holiday, for example. As always, like I mentioned last lesson, it's only comparable and it gives a snapshot of a business. It's an assessment. It's hard to compare one business to another when they are not directly associated with each other. So I mentioned last week Argos and Amazon. They both work in the same industry, but they operate in that industry differently. So it was very, very difficult to actually compare both businesses fully. It gives you a snapshot. It's a part of the puzzle. It's a part of the picture, but it's not the be all and end all. So using the same financial information that you received last week, similar table, I'd like you to have a go at answering question 7. Complete the table. So complete the table for year 1 and year 2 with a current ratio and the liquid capital ratio, using the information from previous. Pause the video and have a go at answering the question. In 10 seconds, I will move forwards. And here's the answers. So the current ratio in year 1 is 1.02 to 1, and in year 2, it is 1.78 to 1. That tells us for every £1 and 2 pence in the bank, and as inventory, as a current asset, we have £1 in liability, and £1.78 pence to £1 liability in year 2, which is current assets, which would be our cash and our stock. And secondly, our liquid capital ratio is 0.79. So for every 79 pence is cash in the bank, we have £1 of liability. And in year 2, £1.39 to every £1 in liability. So what does that tell us? Assess the overall performance of the business in its 2 years of trading. So worth 8 marks, complete 100 to 300 words. I'm going to pause the video and give you the opportunity to answer it. Using the data that you've got from your answers, what's happened? Has there been an increase? Has there been a decrease? Is this a positive or is this a negative? Maybe suggest why. What's happened? How can we impact the current ratio? How can we impact the liquid capital ratio? What may have happened from year 1 to year 2? I'll pause the video, 10 minutes, and then we'll go again and I'll show you the answers. Might be worth every 2 to 3 minutes, teach you to pause the video, get some information from others, little bit of a bullet point, pop that information on the board, which may help others in the group as a sentence starter. 10 seconds and I will move on to a short templated answer. And the answer is coming up. You should have a lot more depth to the answer than on the screen. But an example answer may have been the current ratio has improved as its ability to pay off the debt, i.e. a liability, and making it far more efficient than it was in year 1. As for the liquid capital ratio, it suggests the number of current assets has increased as significantly and that it has a superior amount of current assets relevant to its current liabilities. And that is learning aim F4. There are only 2 ratios. So what's going to happen? We're on slide 25 of 56. I'm going to end the video there. And this will become session 23A. And then I will do a new video of 23B, which will be learning aim F5, which is measuring efficiency. Hopefully you found this video helpful and good work.